Removing money from the economy is going to have a huge impact. By removing money from the economy, that is paying off debt. If debt creates that money, paying that debt off takes the money out of the economy. That is deflationary. If they increase or decrease the interest rates, then what they're doing is in theory anyway, regulating the speed of the inflation. They don't want deflation. They want inflation because that is an invisible tax that we all have to pay. And it impacts those people on the lower income scale versus the higher income scale. Removing money from the economy is what the government and the central bankers do not want to do. And that is paying off debt. They want you to stay in debt. They want you to take on more debt. They want to stay in debt. They take on more debt, which, by the way, we are obligated to pay because they prefer inflation to deflation. There's fixed rate debt and there's variable rate debt. The fixed rate debt, when you have a contract like, say, a mortgage debt, right, that falls right into this strategy. You don't have forever to do it, but when they do that overnight revaluation and gold moves towards its fundamental value, you grab some of it, pay off that debt, and therefore you're paying that debt off with dollars that have little to no value at all. Variable rate debt, that interest rate will climb as confidence is lost in the markets. If you've got variable rate debt and it's not paid off before we go into hyperinflation, the chances of you ever having the ability to pay that off are pretty darn slim.